Guggenheim CIO Scott Minred warns of a crypto washout. Similar to the Internet bubble, Guggenheim Partners Global Chief Investment Officer, CIO, Scott Minred shared in an interview with Bloomberg last week his thoughts on the future of cryptocurrency following the implosion of crypto exchange in FTX. He was asked if he has confidence that Bitcoin and crypto can move forward given the FTX fallout, subsequent contagion, and recent crypto market sell-offs. Minred replied,
Crypto and Bitcoin. Do you have confidence that system can move forward?
I do, Tom. You know, a year ago, we were talking about crypto, and there were approximately 19,000 coins, to which my comment was, this is mostly crap, and there's going to be a washout. And just like the Internet bubble, you know, we will have survivors. And, you know, the digitalization of currency is just in its infancy. And, you know, how this evolves now is going to require, you know, a regulatory framework to legitimize it. Yeah. And I think we will move forward, and I think this will, be transformative to the general economy.
Lisa would like to weigh in here, Mr. Minred.
No, I don't want to weigh in on this per se, but there is a question of whether the whole FTX phenomenon really was born out of the easy money policies and whether there are a lot more shoes to drop in the financial stability aspect of this. As everyone talks soft landing and as we talk about disinflation, how much less of a chance is there of that outcome, which I know you've been talking a lot about?
In terms of the collapse?
Yeah, some sort of, more financial disruptions, shakeouts, that things going to zero that were overnight, that were worth tens of billions of dollars.
Sure. I mean, look, I think there's more to come, Lisa. And the reason is that, this is just like any number of periods where we've had easy money and a lot of speculation. And so the weakest players fall first. And so crypto was obviously something that was crazy. NFTs were, I never quite understood them.
I loved them. The one they did of me was just great, Scott. It worked out like a charm.
But the, you look at what happened with the Bank of England. We averted, I think, a global financial crisis there by their quick response. So, there's, I think, another shoe to drop. And, I can't tell you where it is.
I did a presentation up at the Nantucket Project on crypto, how to deal with it, how to invest in it. And I really thought that, this is a viable investment vehicle. But one of my big concerns is that no one has cracked the paradigm in crypto. And when I say they cracked the paradigm, its use as a currency, right? As you know, the definition of a currency is that it's a medium of exchange, it's a store of value, it's a unit of account.
Not the last 90 days.
Not at all. And so we've learned that none of this stuff, stable coins, the whole bit, everything is suspect.
You're a really, really bright guy. I want you to explain the divide between Alan Auer at the Bank of International Settlements, who owns a high ground with Ken Rogoff at Harvard, on the study of Bitcoin and the entire scarcity, the derived scarcity of it, with the community of Bitcoin that just seems miles apart, and they won't read Alan Auer.
Right. No, well, I think, look, because Bitcoin and any cryptocurrency at this point has not really established itself as a credible institutional investment, right? It's really become the market of a bunch of yahoos and backwaters, and I know I'm already going to be plastered on Twitter now for what I just said.
Good luck when you get back to your desk.
Yeah, exactly.
Lisa's cell phone just melted down over there.
Exactly. But, when you consider we have 19,000 digital currencies or cryptos or whatever we want to call them today. Most of them are junk. They don't make any sense whatsoever.
Do you have any crypto asset investments?
We did. We had Bitcoin. We bought it around 20,000. We sold it at 40,000. And I really thought we were going to correct. After we got to 60, I thought we would correct to 30. We got there. And then I began to look at it and say, why are we stopping here? And so my latest work, which is entirely technical because there's nothing else to look at here, is that we're probably going to hit $8,000 before.
What was that number?
8,000 until we totally flush
So you
out
have
what's
no
going
warrant
on.
holdings?
No.
Okay,
I mean,
well,
if I were, I'd be short. But
well, going
that'll
forward,
get me shot too. So
you've been predictably bearish for a while, talking about how you do think that the U.S. is heading toward a recession, but you've remained sanguine on certain risk assets amid this because of the short term. Has that changed as people bring forward the slowing growth narrative?
Yeah, it definitely, it isn't the slowing growth narrative that caused me to change. It was my time at Stanford a few weeks ago at the Hoover Central Bank Conference. And I saw current Fed officials, ex-Fed officials, and they uniformly were extremely hawkish. I engaged in opportunities to talk about the market and the functioning of the market and so on and so forth. The bottom line is that short of a sudden collapse in equity prices, I don't believe the Federal Reserve is going to respond. The words I kept saying is, as long as the decline remains orderly, we would like to see financial conditions tighten, and that I think is the game plan.
In the land of Michael Boskin, and particularly in the land of John Taylor in the Taylor rule, obviously this is a whole original architecture for everybody involved in economics. But if a central bank blinks, how is that expressed? Is it going to be expressed through dollar dynamics?
Oh, absolutely. I think if the Fed blinks...
We're going to make some news here. Give me a dollar call.
Well, I think as long as we force on tightening, which I think we will through the summer, the dollar's going to do fine. But if the Fed blinks because of financial panic, which I think there's a high probability of toward the second half of the year, then I think the dollar will come under pressure.
What happens, though, if the Fed doesn't blink because of that, but because growth is actually slowing, which is basically what people are pricing in right now?
Right, but I think that for the Fed, the dynamic is not the slowing growth, it's the inflation number. Right, and the growth can slow, and we can still have high inflation, which, you know, Tom is very familiar with. We called it stagflation, and I don't buy into that whole dynamic. But I'm just saying that they're tightening, I think, financial conditions faster than they realize.
Can you use a Taylor rule, given the fiscal impulse we had off a natural medical disaster?
Right. Well, I don't think so. And I think, Tom, what we're looking at here is more akin to the post-Second World War period.
So you're going to give me a 47 analogy here.
Exactly. And the analogy is that we hit 20% inflation in 1946. The Fed stopped expanding the balance sheet, stopped monetizing debt. Fiscal spending was reduced at the end of the war. We had supply shocks as consumers looked to buy consumer goods at the end of the war. Factories were geared for wartime. And by 49, we had a mild recession. Stocks had pulled back 15 to 20%, and it went fine. It's the problem I'm seeing is that we're raising rates, and we're going to shrink the balance sheet at the same time. And I can remember sitting, I think, with you on Bloomberg back in December of 2018 when the chair made his famous statement that the shrinking of the balance sheet was on autopilot, and the next day we were mopping up from the Fed, and the stock market was